Good day. This short module is how to use common size financial statements to start the analysis process. As a review, common size income statements display everything not as dollars, but as percentages of sales. Now, so if we look at this for a second, when we look at dollars, dollars can be misleading. I think if we're looking at over a time period, over a trend, seeing the percentage relationship of an expense to the total sales is more meaningful. So we can look at the trend and try to identify different things that may be happening. For those of you that are in accounting, there is a piece of this is part of FAR. So keep that in mind as you're going, so you get a double whammy here. Why are we doing this? Well, to understand the company and its performance, to identify the company's strengths and weaknesses, to identify variations and trends in major items. What's happening? So where do we start? And this one I probably was not as clear on is the financial statements as you, the 10K in the investor presentation. By now you've realized there's a lot of stuff in there. There's a lot of information that's packed in there. And sometimes it seems overwhelming as to what you should actually be working on. The first thing is review the income statement and balance sheet, not the summary, but the detail. Identify the major categories, large dollar. You have already done this, but you may find it's useful to go back and look again to see if there's anything else we should break out. Then we combine information as appropriate, not too much, just right. We complete the common size statement. Revenue, sales equals 100, assets equal 100, and liability equals 100. Oldest to newest, right to left, but because we're seeing a trend. And as we create forecasts going forward, this will be easier to graph and do some statistical work. So you're now ready to start. So what do we do? Well, the meat. Identify any one-time material items. Okay, so first you identify. This becomes important. You'll see in the couple of examples what is the material one-time item. Then you want to go back and research them and explain what it is, why did it occur, and how, if any, will it impact future periods. So you're always going to start with one-time items, and a lot of companies have these one-time items, and some of them are very valid one-time items and you can pull them out. Other times when you see them every year, you got to begin to wonder, are these one-time items or special items, or is that just part of doing business? So identification is the first step. Then you scan each line and identify variations in the trend. Okay? And by variations, I mean if general and administrative expenses is 20, 20, 20, 20, 20, there's really no reason to look into that. But if we go 20, 23, 21, 18, 16, 21, we need to try to understand what that variance is, what's causing it. Is there something cyclical? Is there something that's included in there that's not repetitive? Or what is going on? So research and explain it. You need to be granular, to be specific. Will it continue in the future? Think cause and effect. Is what you're seeing if you're seeing an effect, what is the cause? Is it capacity? Either over or under utilization of capacity? For the income statement, you want to limit yourself really to understand it to around 4 material items at that. Not much more. For the balance sheet, cover the material items that are not covered except those that you cover in liquidity or capital. You're doing work with liquidity and capital, so you don't need to do that. We could take some looks at that too as we move forward. So the first thing I'm going to do is I am going to review steel dynamics in totality with you, and then I'm going to just take a couple other companies and I'm going to throw in some common size, and I'm going to highlight what you might want to look at. And as always, if you have any questions, please let me know. I'm going to be continuing along with steel dynamics. The first thing I'm going to do is to identify what I want to look at. Then I will do some research and show you what I came up with. Then we'll take Kraft Heinz and we'll identify what questions. So the first thing is to identify what is it that we want to look at. So we can start here, and we have the results over 5 years, and we can see that sales have grown. Now, that would imply that the other costs are moving too. But there's no we can't understand right now, just looking at this, what's the relationship between these costs and sales. So the first thing we're going to do is do the sales analysis. That's a separate exercise. Then, when we go over to the common size, we're going to look for the key trends. So I'm looking here, first line is cost of goods sold. And remember, the difference, the gross profit is total sales less cost of goods sold. 89, 90, 82, 83, 80. So what I'm seeing is I am seeing a trending down. So the first thing I'm going to do is I'm going to highlight that with a nice light blue color. And the question that the research that I'm going to do is, why is the cost of goods sold trending down? Now, remember, it's trending down as a percentage. Important to know. Gross profit's a function of that. So I'm going through SG&A, it's relatively close. Now, what's going on with profit sharing? Because it's going up. Why is the trend of profit sharing up? Okay. Now they broke it out. We look here at amortization of intangibles. Pretty much flat. Pre-tax operating income. That's a result of the other things. Right? Because you're subtracting. So if we find out this and this, we'll find out what's happening on pre-tax income. We look here and here. Now, this is a asset impairment charge. So we're looking, what is the asset impairment charges? The last run is, notice the tax rate is all over the place. So we have, again, what is happening with taxes. Okay, so in this point, I've identified 4 things on the income statement that are specific lines. They affect gross profit, pre-tax income, and net income. So we can't really start with here. If we start with, income was great, and we could go up here and say, look at income is great. Look at this. It's 10%. It's great. But these are the underlying trends or the causes that we're seeing with the effect. So now let's take a couple minutes and see how I position this in the PowerPoint presentation. Okay, so I showed you how I identified what I want to look at, and I've put it here in the PowerPoint, and I have my 4 questions. Why is the cost of goods sold trending down? Why is the trend of profit sharing up? What is the asset impairment charge? And what's happening with taxes? So what I did is I'm trying to focus on the material items that drove revenue besides the growth or change in sales. So how did I end up showing what they are? Why is the cost of goods sold trending down? There's been a significant decrease. Vertical integration at 85% of the costs are variable. Steel mill utilization achieved 96% in 2018. The margin increased over time as more product was produced for the same fixed cost as to when utilization was at 80%. So we have a capacity to produce X, but in the past we were only using, say, 80% of it, but we had 100% of that cost. Now it's 96%, so we're using more of the capacity without having to add costs. Now, at 96%, we're going to really have to expand facilities to continue to grow. The price for value-added products has a better margin. So when we look at what we're able to sell for, these value-added products are selling for more than regular roll steel. At the same time, through cycle utilization, it means how fast does it work, they were able to produce more without any incremental cost. So the cost of goods is trending down, but the lower cost of goods has driven the gross profit higher. So what we have is the effect of the cost of goods trending down was higher gross profit. So that's the first question. The second, why is the trend of profit sharing up? Okay, so the next question is, why is the trend of profit sharing up? What did I find? Is the company has a number of 401k and profit sharing plans for eligible employees which are considered qualified plans for federal income tax purposes. The company's total expense was $156.7, $92.5, $64.7 million for the years ending 18, 17, and 16 respectively. So we know what it was. Now, what we found out is that the profit sharing component is 8% of consolidated pre-tax income with certain exceptions. So the profit sharing component was $138.7 million in 2018. The difference between that and the $156.7 is the 401k contribution. So the biggest piece is this profit sharing component, and 8% is very, very generous. And this is consistent with the increased pre-tax profit. So going forward, we should see this continue to grow, and we can calculate it in our forecasts based on 8% of the pre-tax income. So that can be a formula as we're moving forward. Impairment charges, what are they? Well, in 2014, they wrote down something. It was a non-cash charge. They wrote down the value of another recycling operation. And they related to acquisitions in previous years, and the value that they anticipated did not materialize. This increased the tangible net worth and resulted in lower levels of future amortization and profitability. The fixed charge coverage in 15 was negative. When we adjusted for the non-cash write-down, it was a positive 4. And as of right now, there is $645 million in intangibles based on the companies. So there we know what they are. These tend to all be one-time charges with no negative ramifications going forward. What's happening with taxes? Well, we can see the effective tax rate. So what I did is I converted it from the percentage of income to the effective rate. And we can see some interesting things happening here. But as a result of the Tax Cut and Jobs Act of 2017, the company had $181 million for one-time adjustments as they revalue the deferred tax liabilities. That reduced the effective tax rate by 19.3 to 13.7. And then going forward, the federal tax rate declined the statutory from 35 to 21 in January of 2018. So that's what was happening here. This is close to, if we look at 16, that's the statutory rate, very close. And when we look here, that's very close to. What we see is this big drop here, which was caused by the revaluation of deferred taxes. When we look at 2015, what we found is they had an operating loss for the year, and that was a result of the operating loss and a change in accounting for state tax purposes. So that gives us a sense of what's going on there. Okay, so that was an example of what I looked at to determine the questions and the answer. On this one, we are just going to focus on what are the questions. And it's Kraft Heinz. And I was able to pull the 15, 16, 17, 18 financial statements, internal income statement, and I put them into common size. So the common size that we looked at, I kept it pretty high level because I think it's pretty clear. So when we look at the 100, remember again, this is a percentage of sales. When we actually go up here, we see that sales have changed substantially. And this here, I'll tell you in advance, is a result from here to here is a result of acquisitions. So we're looking at the gross margin. It looks pretty good. What caused the margin to drop in 2015 and then remain stable? So what caused cost of products sold decline from 2015 to 2016 and then remain essentially flat? So that's the first question I see, because that stands out. Now we look at selling general and administrative. Again, we got the same things. So we got 13, 11, 12. It seems to have leveled off. Interest expense. Why is interest expense declining? Now remember, I already did the analysis of the capital, so I'm not sure why that would decline, so that's why I'm looking at it. Okay, obviously 61% is huge. Why is this write-off? What is this write-off? Why did they do it? And again, the tax provision seems to be all over the place. So we need to do that. Now, so these are the 4 questions that I'd follow up here. But again, it's all going to be driven by what's happening up here. Now, I happened to tighten these up. There wasn't a lot of detail that I needed to break down. Each company is going to be a little bit different. So now, take a look at these, and when you move forward with your company, do the same thing to identify the 4 questions you'd like to look at relative to the income statement. We do the same thing for the balance sheet, but remember, we've looked at the liquidity, we've looked at the capital, so it's other things. Please let me know if you've got any questions.